I'm happy to welcome all for this webinar on financial analysis, must skill for every executive. I also wish to title this webinar as how to analyze financial condition of business without going through years of mainstream finance education. We are now living in the world of online education. COVID lockdown has opened up the possibilities for online learning. In the past several months, you would have attended various webinars, various workshops, online programs. You would have attended your own organizational internal training. But despite all this, if you have registered for this webinar, if you are attending this webinar, it means you are seriously looking for some guidance, you are seriously looking for some learning resources. I can give you that assurance. That is, your next 60 plus minutes is going to be the valuable time. You will have lots and lots of takeaway in this next 60 plus minutes. What you require is guidance from right person. I can give you enough guidance. I can act as a resource person for you. That's the assurance from my side. Okay, so what is the objective of this program? What is my goal? My goal is basically to help out two types of executives, bank executives. They should learn financial analysis. Bankers, they should learn financial analysis because when they sanction loan to a borrower, they do credit appraisal, credit analysis, and in that financial analysis is the core. So bank executives, especially credit analysts, credit managers, relationship manager, branch manager, credit risk creator, sales manager, they should have a good knowledge of credit and financial analysis. Similarly, finance executives, they should understand how banks are going to evaluate their business. They should understand what are the expectations of financial business as well. So that's my goal here. Twin objectives. One is to help bank executives. The other one is to help finance executives. So shall we begin? Are you ready? If you are ready, type start. If you are ready, type start. Thank you very much. Let's go through a small story. Over a period of 5 to 6 years, I was training thousands of bank executives on topics like credit analysis, financial analysis, working capital, term loan. This is happening for the past 5 to 6 years. But all this did not happen just like that because I need some foundation, right? How I am teaching this, from where I have learned all this. Let's go back to 2008. In 2008, I joined SBI as credit analyst immediately after my chartered accountancy qualification. I used to say it's just one day before completing my CA program in campus I was selected. So I had this in March headway also because completed CA in first attempt, got job in SBI, that to joining as credit analyst. Wow. Okay. So I joined SBI, and first 4 months that gave me literal nightmare. The profile of credit analyst, credit analysis was not as simple as what I thought. Because in CA final and all, we have done extensive, complicated study, analysis, everything. But when I faced that reality, it shocked me. Day in and day out, we'll be getting balance sheets of corporate customers, business entities. You have to read the balance sheet, you have to analyze, you have to read line by line items, you have to read in between lines, you have to arrive at ratios, you have to analyze, interpret them, then see their cash flow statement, fund flow statement, then do the credit risk rating, then put up a appraisal, then attend committee meetings, get firing, answer the questions, and in the meantime 3 to 4 other proposals will be in queue. Again, you have to analyze different customers absolutely with the difference. So 3 to 4 months was absolute nightmare. Despite being a chartered accountant, I faced lots and lots of difficulty in understanding what this credit analysis and financial analysis is all about. But thank God, I had good mentors in SBI. They guided me. With their guidance, I was able to pick up things very fast. And within a period of 1 year, I got elevated as team leader of credit processing cell. And over a period of 4 years in SBI, I worked on 250 plus projects. It's 5,000 crore plus size. But what I came across is, despite being a chartered accountant, I struggled a lot. And when I was elevated as team leader, I had newcomers reporting to me who are basically from non-finance background, engineers, science graduates. They struggle in understanding basic accounting. Then comes balance sheet, then comes financial analysis. They had so much of difficulties. So at the time, they used to ask me to teach on basic things. So in the evening time, I used to teach them what is accounting, what is balance sheet, what are ratios, cash flows, fund flows. It started then. It started in 2008 onwards, I can say. And this journey continued for a period of 4 years. Then I came out, I got into CA practice. I had my practice for a period of 7.5 years with more focus on project funding, debt syndication. So again, what I witnessed is, whenever I go to bank, whenever I represent a client, the bankers on the other side were found to be on the weaker position, because client has good knowledge of his business, but bank executive, they are basically shifted from some other department and they have very little idea about what this financial analysis is all about, and many times they fumble. I've seen this. So I started training bankers on credit and financial analysis areas, so that they can approach or they can face their customers very confidently. I started teaching through bank internal training programs. I also empaneled myself as trainer with a few banks. Then I explored technology.
Thanks to technology, today I teach 2 lakh plus students, of which 1,91,000 plus students are from Udemy portal and 35,000 plus students are from my own portal, CA Raja Classes. Our YouTube channel crossed 1 lakh plus subscribers and my teaching journey was also featured in New Indian Express.
I also received Indian Achievers Award 2021 from Indian Achievers Forum for contribution in nation building through teaching. So in that law, I wish to ask you once again, are you really serious about learning financial analysis? Are you really serious about learning financial analysis? If yes, yes, please type this. ISAFA. I am serious about financial analysis. Just type ISAFA. I'll keep asking you to type out some small things like this. It's basically to ensure we are connected. For me, it happens now and then. Without any notice, my internet connection will go. Okay, so that can happen even today also. So if at all that happens, I would request you to stay back for another 5 to 10 minutes. In the meantime, I can make other arrangements. Okay, so if you are learning financial analysis today, type ISAFA.
Let's get started with today's presentation. Financial analysis is a must skill for every banking executive. As a bank executive, why you have to understand financial analysis? Remember one thing, what is the core business of banking? The core business is lending. And how bank takes that decision? They take that lending decision by carrying out something known as credit analysis, and in that financial analysis plays a very significant role. So if you want to rise up in your organizational hierarchy in bank, you should know what is the core business of banking and you should be in a position to take that decision as well. So for that you have to understand the elements, the factors related to that, and in that financial analysis is very important. Financial analysis of whom? Financial analysis of borrowers, because when they come to the bank approach for a loan, the bank should be in a position to evaluate the customer, then take a decision, and they can do that partly by carrying out financial analysis. And when I say financial analysis, it is analyzing their financial statements, the audited or the past financials, and also their estimated projected financials. And for carrying out that analysis, we are going to use three critical tools. One is financial ratio analysis, two is cash flow analysis, and three is fund flow analysis. Let's get started with financial ratio analysis. I'm going to take you through an example. Let's say there is company A and company B. Company A has reported a profit of 10 crore and company B has reported a profit of 5 crore. If I ask you which company had performed well at this point, what will be your answer?
It's a simple question. It's like taking a baby step, but still, I want all of you to participate. Some of you may even feel information is inadequate to take a decision, but let's take that baby step. Let's take that baby step. You have to say which company is performing better. Yes, I could see answers coming like most of you are saying yes, yay, yay, yay. So I could see more of yay. And very few said can't take a decision now. And so the conclusion, I'm going to make it like this. Majority said A and very few said they need some more information. Okay, let's see in what direction this goes. Let's see. Yeah.
Most of you would say company A, right? Because company A has reported a profit of 10 crore. But if I supply you one piece of information, that is the sales achieved by this company, company A has achieved the sales of 100 crore and company B has achieved a sales of 25 crore. And if I ask you once again, which company has performed well now, what will be your answer?
Yeah, earlier, at least some of you would have felt that, or you have expressed also that information is inadequate to take a decision, and I'm literally forcing you to take a decision. So now this time I have supplied something important and relevant information. And remember, earlier majority of you said A. Majority of you said it's company A that is performing better. Now let's look at the kind of shift that is going to happen. And I know it's a very elementary question. This is not rocket science. I'm not teaching you something hi-fi here. I'm not teaching you the advanced concepts in financial analysis. We are just taking our baby step, but you are going to see the kind of impact financial analysis can have on your decision. That's what I'm trying to bring out here. And I could see answers coming like, so what I could see is now majority of the answers are coming in favor of B. I think it's a drastic shift. Majority of you are saying B. Why this happened? Why this happened? See, earlier you took a decision based on raw data. That's why majority selected A. But when I supplied you that additional piece of information, that critical and logical information which you can relate with, you did that analysis. I believe you did that meaningful analysis, and I believe you have taken a quality decision. How many of you agree with me that you have taken a quality decision now? Because earlier you chose A, but now you have selected B. And how many of you believe that B is actually performing better? If you believe yes, please type yes. And if you changed your opinion, please type me. It means you have changed your opinion. It's a confession. Do that confession. It's good because you are learning now. Okay. See, even now there are many other factors. We cannot take a decision just by looking at the profit alone. Okay. There are many other factors, but let us take our baby step. We'll take about step one, step two, then we'll go deeper and deeper. But given this information, now we can conclude that B is actually performing better than A. Earlier, majority of you said A, but many of you could change your decision. It means now you have taken an informed decision. Earlier decision was taken on the basis of raw data, but now it is analytical information, and you have taken a quality decision. And that's the power of financial analysis. And that's why I maintain financial analysis as the core. So once again, with this note, I welcome all of you for joining this webinar, and let's get into the world of financial analysis. And this is the way in which we are going to learn today. And if you find this way of learning interesting, please type cool, C-O-O-L. Or if you find it super cool, you are welcome to type super cool as well. But let me admit, it's not rocket science. These are all simple concepts. I just got the privilege of introducing them to you. Yeah, thank you so much. Thank you for all those cool, super cool comments. Let's get into the discussion.
There will be a drastic shift, right? Because earlier, most of you would have favored company A, but now majority of you will be favoring company B. What happened? When you looked at the standalone figure, it was deceiving because profit of 10 crore looked better than profit of 5 crore. Yes, that's true. But when you gone deeper by comparing the profit with sales, you were able to calculate the profit margin. Company A has reported a profit of 10 crore on 100 crore. It means they have a profit margin of 10%. Whereas company B has reported a profit of 5 crore on 25 crore. It means they have profit margin of 20%. So what's happening? Company B has performed well. In this case, what we have done is we have compared the profit with sales and we have calculated this ratio. Profit by sales into 100. That is what we have calculated as profitability or profit margin. Okay. So ratios are basically a relationship between two numbers which are created in a logical way. Yes, we related sales and profits, and it's a relationship between two numbers, and there was a logic in relating the sales and profit because we can measure profitability. We related current assets and current liability to numbers, and the logic is it helps us to understand the liquidity. Okay, so ratios are relationship between two numbers which are created in a logical way, and it will help us to understand the past, present and future performance, and it will also help us to understand the strengths and weaknesses of businesses. Yes, by looking at the profitability ratio, we were able to understand like which company is performing well. So we have understood the strength and weakness. So like that we can give many variations. Okay, so that's about ratios, and we are going to understand the ratios by looking at its classifications. Ratios are broadly categorized. They are liquidity ratios, capital structure or leverage ratios, activity ratios, and profitability ratios. First, let's get started with liquidity ratios. Liquidity is basically ability of the business to meet its short-term expenses, short-term obligations without difficulty. At this point, I just want to bring the balance sheet here. So those who don't know what is balance sheet is a simple statement which will show from where and all money had come for business and where and all that money had been used. Okay, so for business, money can come from owners, we call it as equity. Money can come from outsiders, we call it as liabilities. When money comes from outsiders, it can come with an obligation to pay within 1 year or pay after 1 year. If it comes with an obligation to pay within 1 year, we call them as short-term liabilities because we have to pay within 1 year. And using these money, which are basically raised as repayable within 1 year, which we call them as short-term liability, we can use this liability money to create asset, that is short-term asset. But if you look at this, the short-term assets are greater than short-term liability. How it is possible? Because the short-term what is raised in yellow box is smaller, but short-term assets are larger. It means this short-term assets could not have been created without the support of some long-term funds, because only a portion of short-term assets are funded by short-term liabilities. It means there got to be some remaining funds which have been used in creating short-term assets, and that's how it should be for every business. Short-term assets should be greater than short-term liabilities, because short-term liabilities are those liabilities which you have to repay within 1 year, and for repaying that you need resources. Resources will be in the form of short-term assets, so the resources should always be greater than the obligation. That's why I've captured the short-term assets as larger size and short-term liabilities as smaller size. That's how it should be for an ideal business. Okay, right. Now, to understand this liquidity concept, let's first digest this fund utilization principle.
Yes, whatever you see on screen, I mean it. This fund utilization principle is going to be the very, very important segment of this webinar. I would call this segment as the savior for banking system, entrepreneurs, employees, everyone. Such a powerful principle. Do not miss even a single point. If you don't have your notepad and pen, please go and grab it, because it's such a powerful principle which you will agree for after the end of this explanation. Okay, so let's continue.
whoever attending this webinar, whether you work in a bank or whether you are an entrepreneur or a finance manager or a chartered accountant or a cost accountant, okay, please take this principle to your heart, to your mind, and try to teach this to as many entrepreneurs as possible, because several businesses fail because of not understanding this principle. Okay, now listen. I said money for business can be raised from the owners, we call it as equity. It can be raised from outsiders, we call it as liabilities. And this liability can be short-term liability, and these short-term liability can be used for creating assets. They are called short-term assets. But here, if you look at short-term assets are greater than short-term liabilities, it means a portion, a portion of short-term assets are funded by long-term funds. I call them as long-term liabilities and equity. So this gives rise to the understanding that equity, the money contributed by the owners, is always long-term. And long payable. So it can be a term loan, it can be a debenture. Okay. So if you look at the composition here, short-term are created using a portion, using an entire portion short-term liabilities and some portion of long-term funds, I call it. You still have some more long-term funds which can be used for creating long-term assets. And some portion of long-term funds, I call it. So still have some more long-term funds can be using long assets. Now what's the fund utilization? If you are raising short-term funds, you can use it for creating short-term assets. It is good. If you are raising long-term funds, you can use it for creating long-term assets. That is also good. Use funds for asset is considered as ideal, but one thing that should never ever happen in any business is never ever use short-term funds for creating, never ever use short-term funds for creating long-term funds. I say that short-term funds are raised with a promise that you will repay within 1 year. And if you want to repay within 1 year, you should have invested that money in short-term assets. Only those assets can be converted to cash within a period of 1 year. So use that cash to pay back the short-term liability. On the other side, if you use the short-term liability including long-term assets, by name, very nature, they are long-term assets. It means those are all the assets which cannot be converted into cash within a period of 1 year. You borrowed with a promise you will repay within 1 year. So when the due date approach, if you look back, you will not have short-term assets. What you will have is only long-term assets. Long-term assets, by nature, by very definition, can be converted into cash within a period of 1 year. Then you will carry sorry figure or you will face lender. Imagine that